Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. As always, I'm Mangalam Malu. With me, Hormas Patakia. Joining us from our Bangalore studios is Ritu Singh. Yes, the frontline indices, they're in the red, but nothing really to worry about. Why do I say that? Because from the lows, we've seen a recovery on the Nifty. The Nifty, which closed above that 26,000 mark on Friday, opened a shade lower today. From that decline, we've seen a dip being bought, and the Nifty has recovered almost, 90 points from those lows. A large part of that recovery is led by the IT index. While all indices, sectoral indices, are in the red, the IT index has actually staged a massive recovery, currently at the high point, led by the weakness that we're seeing in Rupee, which Ritu will talk about a lot more. And look at the advanced decline ratio as well. Even as the indices have recovered from the lows, there are more stocks which are advancing than the number of stocks which are declining. That should make bulls feel happy. So we're down, but perhaps not out. Hi Ritu, good morning, happy Monday.
Good morning, happy Monday, Mangalam. Down and not out. In fact, about 1437 stocks advancing compared to about 1361 declining, which is a bit of an improvement from how we saw the trading session start today. But yes, market's still under pressure, and Rupee that you spoke about hitting an all-time low again at 90.70 is the level we saw today. We'll have to see if it's 50 makes that move towards 91. I think that's the next mark to watch out for, or whether RBI will intervene to stop that kind of a fall. Lots of buzzing stocks today. We've covered some of those for you in trade today, but the top losers, look at CCL products, PNB Housing, some of the insurance names, the New India Insurance Company, PB Fintech, ONGC, some other names like Credit Access Grameen. These are some of the top losers in trade. But Hormas is standing by with the key buzzers. Hormas?
No reason to complain whatsoever, at least as of now. The dip getting bought into and the broader markets too fighting to hold on to some resemblance of gains, or at least ensuring that the fall does not widen. We'll start off with WPIL today. Is the biggest single day gain that the stock has seen in the last 4 months. There's a 9% up move in today's session. The stock has seen 1 lakh or more shares trade for the first time in a month now. There are 1.8 lakh shares that have been traded. The 20-day average of just around 22,000 shares, so almost 9x of its 20-day average. The key move remains below key moving averages, but the important levels first to watch is the 50 DMA at 421 and the 200 DMA at 423. The stock has had a disappointing year so far. It's down 44%. It's turning out to be the worst year that the stock has had since 2008. The other one today is Reflex Industries. We'll talk about that in just a bit. 10% higher. It's a 30% recovery from the opening lows. The stock was up only once in the last 5 sessions going into today's trade. Well over 2 crore shares have been traded now on Reflex Industries. The 20-day average of just 10 lakh shares. Now, the stock still remains below key moving averages since the 7th of November. It has not managed to cross any of those important levels. And this one too, down 42% so far this year, turning out to be the worst calendar year since 2012. And lastly, Coffee Day Enterprises, again, the biggest single day gain in the last 4 months. The stock had done well in 3 out of the last 4 trading sessions. Close to 20 lakh shares that have been traded on the stock today. 20-day average of just around 1.5 lakh. The 200-day moving average, it has moved above that now at 35.65. The 50 DMA comes up to 39. So that's the other important level to watch. The stock has done well this year, up around 60%, but was down 60% last year. So cancels itself out. Back to you guys.
All right, take that point, cancels itself out. That's the view coming in on a bunch of these buzzing stocks. In fact, just look at PVR. The stock is up around 7%. Weekend reports of, Dhurandhar did suggest that there was a good, recovery, good collection. The movies crossed over 300 crores in gross collections so far. Importantly, the line of movies which are slated for release in this quarter and towards the next quarter as well, looking good. So there is a fervor among people in terms of going and watching movies, so to say. But is that so in travel as well? Looks like it. Luxury travel still here to stay. TBO Tek is one of those stocks which is doing well because the company held its analyst meet in Dubai last week. And we did have a bunch of brokerage notes coming in. Jefferies, for one, stands out because they retain their buy rating on the stock. They've increase the target price from 1,800 rupees to about 1,950 rupees. And the key takeaways that they have, they say that offline agents, the business that the company is in, are still relevant amid rising luxury and experiential travel demand. The company is scaling artificial intelligence tools to empower advisors and partners. They have some of the important ones like Emirates and Hilton across the world. And key account manager investors are all tapering. So going forward from here on. Margin turnaround is underway. So with these three key takeaways, what have they done to their estimates? If you look at their FY28 revenue, EBITDA and profit estimates, profit jumps from about 200 crores to 544 crores. EBITDA jumps from 300 crores, more than doubles to 760 crores. All of this on the back of the revenue growing from 1,700 crores to about 4,300 crores, led by good gross GMV addition, gross merchandise value, and increase in take rate as well. So TBO Tek doing well, the stock holding up in the green.
All right, let's get some broader views as well, Manglam. JP Morgan's head of Asia equity strategy, Rajiv Batra, believes that the bull case for the Nifty by the end of 2026, that is next year, is going to be 33,000. He also shared the key triggers that will aid this kind of a growth. Take a look.
We saw some signs of it during the September quarter result, where we got close to 9% bottom line growth overall from MSCI India, surprising to most of the sell side over there. Now we are moving into a cycle where next 4 to 6 quarters you will be getting early double-digit kind of an earning growth number, and potentially even a surprise like ongoing quarter, and that leads to you towards almost 14 to 15% upside on a base case. In a bull case, you require a trade deal. And that's where the re-rating will click in. And with 15% earning growth plus close to around 14 to 15% re-rating, you get up to the bull case. But bull case require a trade deal between India and US. Any kind of a trade deal or a truce happen or relationship get fully normalized over there, definitely re-rating will be back on the tables. So if you look at again emerging market performance this year, 75% of a return for emerging markets or even global market could be explained to valuation re-rating. India has seen valuation de-rating because India's relationship US was not that great enough what it happened last year. So only driver left for India is either currency, dividend or earnings. Earnings was also missing. So let's suppose if earnings make a comeback at a 12, 15 or 13% handle, that's the short return you will get. On top of it, even if the relationship remain on the sideline, you can expect zero valuation re-rating. But in case if relationship get marginally better, 5%, fully better, maybe 15% re-rating you will enjoy. So that's the difference between base and bull case will be. But encouraging part is, as you can see for the past few days, talks have again started happening between the PMs and the presidents overall. We have seen in month of October the defense deal was being done and people are warming up to it. So you can say as a base case, the first line of post you want the 25% penalty tariff that was imposed on India for Russian oil import. That needs to come down because India's Russian oil import has come down. So if that tariff goes away, market will start pricing. Things are moving towards much more better level.
Rajiv Batra of JP Morgan there. Just before we take that break, pull up a lot of these pump companies and they have been doing fairly well since the last week. Shakti Pumps is one of them and it received orders last week, and in line with Shakti Pumps, a lot of other companies also had received orders from the Maharashtra state company. So 11.5% higher on Shakti Pumps, and Vishnu Prakash Punglia, that too is one of those companies related to the Jal Jeevan mission. That too is trading with gains of around 4.5% today, recovered from the lows of the day, of course well below its IPO price of 99 rupees. So keep these pump companies on your radar as well. Take a short break. Market technicals on the other side with Saumil Mehta of Mirae Asset Share Khana.
Welcome back. You're watching Trading Hour. The markets remain in the red. Sensex down about 200 points as we speak and Nifty about 66. But the rupee has been in focus yet again, touching another fresh low in trade today. Now it has recovered a bit from there at about 90.63. But the fresh low it hit today against the dollar was 90.73 compared to the Friday close of about 90.41. Now dealers have been talking about a large RBI sell position in the NDF for offshore market 1 month ago. That matures today and that could be pressuring the spot rupee. But Lata is here with more. Lata, what are the reasons why we're seeing this fresh pressure, and that November trade data is also going to be key to watch out for?
Yeah, actually it's yet another day and yet more FPI dollar buying. But yeah, the specific reason today, what makes it different from 2 days ago, is that this 1 month ago sell position that RBI entered in the NDF market was a 1-month sell-by, and that, NDF market pressures the spot market. In the spot market, the Reserve Bank has been supplying dollars, but as in the past several weeks, it is not trying to defend any level. It's just offering once in a way. So the market is kind of reconciled to further falls. The demand has come from equity FPIs, but dealers are saying increasingly we are also seeing demand from debt FPIs. Actually, year to date, we are positive on debt FPIs. It's an inflow of $8 billion. But lately, dealers are saying there is a sell because people are seeing the currency bleeding, and that's taking down their profit. So some selling is coming from that quarter as well. And then the most important number that dealers are looking at is the November trade deficit. A CNBC-TV18 poll gave us a number of about 29-30 billion trade deficit. This compares with 41 billion, which was the October trade deficit. We put it to one-offs, the economy getting used to the US tariffs and the festive season gold buying. If it were to surprise in the negative and be way over that 30 billion that the market is mentally prepared for, then there can be further reverses, further attacks on the currency is what dealers worry. So important day to watch out.
Lata, thank you for that update there on the rupee. Of course, another low, another day. 90.72 is where the currency had depreciated to. Some recovery from the lows in 90.64, and that has had a bearing on a lot of these IT companies, the IT index recovering from the lows of the day, and that has contributed to the Nifty's recovery from the opening lows as well. But one stock that has been on the radar all through last week has been Hindustan Zinc. It had its best week since May of 2024, and it is now catching the eye of some analysts as well. Nigel is here to tell us more about that. Nigel.
Well, that's right. Jefferies has initiated coverage on Hindustan Zinc with a buy rating and a target price of around 660 rupees. They've highlighted a few factors and try to summarize it in 5 top factors. On the EPS expectations, they expect the EPS to rise by around 22 to around 29% in the next 2 fiscals, that is 26 as well as 27, and 7% in FY28. Jefferies, well, they go on to state that their estimates are around 9 to 31% higher than the street. Point number 2 on valuation. Stock is not cheap, trading at around 9.2 times EV upon EBITDA, which is above the 10-year average of around 7.3. They say that this is justified, going by the rising share of silver in the EBIT. On the price assumptions, actually, they are relatively lower in comparison to the spot rates. So on zinc, they are closer to around 4% below spot, while on silver, they're 3 to around 10% below spot. Moving to the volume growth assumptions, well, they're very, very timid on that front because they expect that the metal sales to grow at just 2% CAGR over FY25 to FY28 because expansions will come on stream only in the second quarter of FY29. They say that the refined metal capacity will go up by closer to 34%, but that's 2 years ahead, as well as silver capacity will go up by closer to 4%. Finally, on the free cash flows as well as ROE expectations, they're expecting strong free cash flows of around 8,000 to around 14,800 crores per year over the next few years, while they're expecting ROEs to be in the vicinity of around 69 to around 85%. Put all this together, Jefferies initiating coverage on Hindustan Zinc and positive on the stock.
Take that point, Nigel. Thanks a lot for that. Meanwhile, we have Matrimony at the bottom of your screen. The board approves a buyback of up to 8.9 lakh shares, which amounts to about 58.5 crore rupees at 655 rupees a piece, and the stock's seen a bit of a spike up around 2.2%. Remember, when the news of the board meet was announced, we did see a big spike on the stock as well. Take a short break, get you more on the markets and a lot of stock-specific action on the other side.
75 points lower on the index. The Matrimony stock has given up all of its gains and has now slipped into the red after the buyback announcement that was made at 655 rupees. This perhaps is the lowest buyback price that the company has announced after the previous 3 buybacks. So 2 of them were in excess of 1,000 rupees. The last one was around 825. So this one being the lowest among the 4 buybacks that the company has announced. There's a 4th one, of course, that the company has announced. But good time to get in Manglam, who's jumped across to the FNO desk to get us the latest trends from there. Manglam.
Well, just the way I jumped across to the FNO desk, the market's jumped from lows as well. So you have the Nifty Bank and the mid-cap index. Now, sitting with mild cuts, nothing really to worry about. Why do I say that? Because, today's low on the Nifty, 25,904. We've seen a recovery of almost 70 points from those levels. And at the same time, the range has been fairly well defined. Earlier, it was a slightly broader range, the 50-day moving average at the lower level to about 100, the 20-day moving average at the higher level. Now you have today's low, which is an important reference point. So 25,900 is, an important support. So supports come higher by about 100, 150 points, while the resistance still, or the supply, is still around that 26,000 to 26,050 mark. What's supporting the index right now? The weakness on the rupee is actually, a benefit for the IT space, and the IT index is higher, and that's the reason why there is downside protection on the frontline index. The broader market too has seen recovery for the advances. So, the crisscross lines come up for you. They're split right down in the middle, even as the market's lower, with the advances actually slightly outnumbering the declines. And there has been no major spike in the India VIX as well. So the India VIX currently comes up for you holding around that level of 10.5, closer to 10. So all of this is a positive from a bull standpoint. The only thing that we're watching out for, whether the market sustains above this 26,060, 26,070 mark. Why do I say that? Because there are still call writers who are active at that level. So 26,000 call comes up for you. Premium of 53 rupees, telling you around 2650 to 2660. It's if the Nifty crosses that is when these call writers will start feeling the heat. Put writers fairly active at the 25,900 mark as well, pointing out that today's low and a 50 point below that is an important support area for the frontline index. A lot of individual stocks on our radar. So NBCC has seen a fair amount of long build up today, and it saw some order wins on Friday as well. In KEI Industries and Siemens, both these stocks are seeing some shots being covered. Remember, Siemens was among the losers on Friday after management guidance that came in, but those shots are now getting undone, and as a result of which the stock is higher by about 1%.
All right, good time to bring in Somil Mehta. He's from Mirae Asset Sharekhan, joining us for a quick technical check of the market. Somil, what's your call at 11:24 now, and your top stock picks for the day?
Good morning to everyone. View remains positive. It's been a little disappointing today's move with the opening and a little, a correction. But I think the trend still remains positive as we are trading above the 40 daily moving average and weekly monthly charts showing high top, high bottom formation. Now, the correction which we have seen in the last couple of weeks has completed in a ABC corrective and taken support at 40 and 50 daily moving average. And that's a very good sign. And we have seen a very good recovery in the last two trading sessions last week. So the trend remains positive in the short term, medium term, both. Crucial level to watch out would be 25,830 and 25,800. So these are the two levels to watch out for on the downside. My target still remains 26,300 and 26,700 in the short to medium term outlook. So buy on decline should be the strategy. For Bank Nifty, very specifically, a small pennant pattern has been forming, a small consolidation is happening, and I'll be expecting this to break on the upside. Crucial support around 58,530. And the trend remains positive. Buy on decline should be the strategy. My targets would be around 60,500, 600 levels in the short to medium term outlook. So remain positive, and buy on decline should be the strategy for both. My two stocks would be IOC, showing good strength today. Ending diagonal pattern has broken on the upside. So the stop loss would be 162 and target would be 175. And the other one is TCS, has been a little, on the corrective side, but I think this is the right time to get into the stock for the target of around 3,400 and stop loss would be 3,140.
Somil, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. Indian Oil and TCS among those recommendations there. Indian Oil at the highest point of the day, now close to 2% higher. The oil marketing company is receiving yet another positive note from vendors today on valuation comfort. So yet another analyst citing valuation comfort for these oil marketing companies behind its bullish stance. Take a short break. Up next, to continue our conversations with the markets, Dheeraj Sachdev of Roha Ventures joins in on the other side.
Welcome back. Let's focus on the bond space as we're speaking about the rupee being at record low. Is there an impact in the bonds market or no? And what can one do? Manisha Gupta joins in from the latest in the Niti Aayog report. Right, we'll try and repatch that connection with Manisha. In the meanwhile, just keep an eye out on a couple of these stocks which are spiking right now. An unusual beneficiary of maybe a weaker rupee could be some of these chemical exporters as well. So Aarti Industries, for one, is up 7% right now as we speak. Deepak Nitrite is the other one which has seen a recovery from the lows. Also see some traction on a couple of these banks. IDFC First Bank currently has moved higher. We're seeing Bandhan Bank move higher too. And as we move towards the winter part of the year, Varun Beverages, understandably, where this quarter is not particularly good for them for the India business, but does well for the South Africa business, has seen a bit of a spike. But I do believe we have Manisha back with us. Manisha, over to you. All right. So, okay, what we'll do is we'll discuss markets with Dheeraj Sachdev of Roha Ventures, who joins in to discuss the market fundamentals, more importantly, his top sectoral picks as well. Dheeraj, the street believes that consumption is likely to recover given the sort of steps that the government has taken, etc. I just wanted to know how much of that is in the price already. And secondly, with the rupee weakening, do you see that as a risk, a further risk of FII outflow over and above what we've seen already?
Yeah, hi, good morning. So specifically on the consumption side, I think we are seeing a host of segments within the consumption basket, and not all of them are equally valued. I mean, there are certain segments of the consumption basket which are overvalued while some offer opportunities. But we are positive structurally because given the underpenetration or better credit or improving credit cycle, lower interest rates or better monsoons, and of course the policy initiatives like tax or interest rates or GST cuts. Now there is a clear shift from unorganized to organized players across many segments of the consumption basket, which includes digital media or jewelry segment or value fashion segment, or even organized retail players within the alcohol beverages, etc. So in consumption basket, we are avoiding durables that are expensive on valuations and an FMCG segment which are facing D2C competition, particularly of late because of the online channels and has slower growth rates. So this is where the space is divided in the consumption basket. On the FII flow, I think we don't believe that the FII outflows, which has been over the last few months, is going to be the case going forward. In case rupee has already depreciated about 4-5%, it's quite possible that FIIs would like to come in maybe early part of next year or the whole of next year, and not only gain on the currency front, but also on the equity, given the valuations in some cases has corrected over the last few months. So we don't believe that FII outflows will have pressure because of the rupee.
Dheeraj, I was just reading your note where one of your points mentioned that there are some contra opportunities that are emerging in some of the good quality companies which are currently lacking growth, or a temporary cycle at that. Does EMS fall into that, or do you still believe that even after the kind of correction that these companies have seen, they still fall on the expensive side?
No. Certainly EMS is not a contra opportunity. EMS is a well-discovered thing over the last couple of years, and the valuations have gone ahead of time. And the earnings are yet to catch up, and they're still expensive. So I think one has to take a longer term call on this business. While it is very structural, India's manufacturing cycle has started, and EMS companies will gain over the longer period of time. But valuations are so demanding, and I don't think it offers margin of safety. What we said on the contra opportunities is that there are quality players where they are passing through temporary growth issues. And because of that, the market has hammered them quarter after quarter over the last few, or maybe last couple of quarters. And this may include some companies in the specialty chemical segment, or a fewer manufacturing or capital goods companies where capex is done and the earnings growth will play out over the next 2 or 3 years. And that is where the contra opportunities we are talking about.
Good morning. Hi, this is Ritu. You're also a core overweight for you is also banks and NBFCs. There, of course, with the spate of rate cuts, a bit of margin pressure in the near term, but the larger, environment of regulatory easing we've been seeing from RBI, where do you see sustainable growth opportunities without a compromise on asset quality? And, the second sector is auto and the CV cycle, where you believe the upcycle is just about starting. Just give us your broad view on why you think the sector has legs and, some of the interesting names that excite you.
Yeah, so good morning, Ritu. See, I think India is clearly we all know that it's a capital-starved economy, and banking and financial services industries have become growth businesses. In a capital-starved economy, there are a lot of companies in the NBFC or banks who are offering specialized financing. So whether it is home financing or commercial vehicle financing or gold financing or even SME financing. And that is going to see a sustained credit growth over a period of time. So they are growth businesses as a sector as such. Only thing is that we have to be obviously cognizant there are a number of NBFC players and there are a number of banks. And those in the mortgage lending business ideally should be preferred, or those who have better strict risk control norms in place. So we have a plethora of opportunities for banks and NBFCs. And in this market, which has been slightly on the higher side in terms of valuations, banks and NBFCs do offer opportunities. In auto, what we are seeing is, again, there are a number of players and it's again a heterogeneous sector, but we are beginning to see a CV cycle on the uptrend. And this upcycle will help a lot of ancillaries which are exposed to CVs, whether it is tires or forging companies or axle companies, including the OEM companies themselves in the CV space. And also there could be better replacement demand that can come from new emission norms in CV. Besides the EV transition that is happening even within the MHCV, LCV spaces. So I think auto ancillary and auto.
All right, we take that point. Unfortunately, lost that feed. But just, before we go across to Manisha, pull up Wakefit Innovations. The stock listed with a slight discount, thereafter fell all the way down to about 10% decline from its issue price of 195 rupees. And now as we speak, the intraday chart of Wakefit Innovation comes up for you. It's seen a massive recovery from the lows, closing in on that 200 rupee mark. Remember, the management joined us today and they do believe that this 20% sort of revenue CAGR will continue for them. And they have a headroom of almost 500 to 700 basis points when it comes to margins as well. So near 20% margins by FY28, not out of whack is what the management said to us when we posed them this specific question. As you can see, opened flattish. Thereafter, there was a decline. That decline has been bought into. The stock now up 2%. But with that, let's go across to Manisha Gupta, who is with us on all things bonds. Manisha.
Well, thank you so much for that, Mangalam. When it comes to Indian rupee, well, yes, we've seen all-time lows onto that one continuing. When it comes to bonds, the awareness, the interest seems to be really gaining, as we've seen in 2025 as well. Very strong volumes coming in. Interestingly, the Niti Aayog also has released a report about deepening the corporate bond market in India. It has outlined a roadmap for the short term and a longer term as well. Well, the current market, when it comes to bond market, is 16% of GDP, and there are a lot of points put forth on how it can be increased by 2030 and 2047 as well, aligning into that Viksit Bharat. So some key challenges that the report puts out. One is about shallow secondary market. We have seen low liquidity and, price transparency is something that needs to be worked upon. Second is about the concentration of investors, because there is over-reliance on banks and limited participation coming in from MSMEs, retail and FPIs, and that needs to be increased. Third is about the regulatory hurdles as well, where overlapping rules and complex disclosures, also about procedural delays, is something that the report talks about tackling. Investor constraints as well, because investor norms are limiting institutional exposures in lower rated bonds. And then it also is about weak recovery, inefficient debt and recovery mechanisms, which the report says should be worked upon. So what are the proposed reforms in that sense? One is about strengthening the market, ensuring that infrastructure is developed in sense of single databases. There is better settlement systems, and digital tools also are active in sense of market making. The second thing that the report suggests is broadening the investor base, introducing more benefit and incentives for first-time investors here. And then, of course, it is about enhancing the regulatory framework, creating unified market authorities, and simplifying the issuance processes. A couple of more things that the report suggests is, one, innovation of instruments so that it caters to different investors' needs. And when it comes to bond markets, it also is about strengthening the legal framework, improving debt recovery, and also bankruptcy resolution. So a very, very interesting report, very opportune time as well. 2025 has seen very strong numbers, with markets anticipating that by 2026 end, you could be looking at the recent numbers perhaps doubling up.
All right, Manisha, on that note, thanks very much for joining in. We have to take a short break, but don't go anywhere, because when we return, there is a special discussion we had at the Motilal Oswal Wealth Creation Study that we'll bring you on the other side.
CNBC-TV18 and India Bonds presents Bond Street.
Welcome back. On to a special snippet from the Motilal Oswal Wealth Creation Study. Market veterans Ramdev Agrawal and Ramesh Damani spoke to CNBC-TV18's Prashant Nair about their wealth creation formulas and the importance of picking leaders to maximize the power of compounding. Listen to what they had to say.
Which of the, you say ROEs, tailwinds, leadership, and many more, as you stand with your experience and, I mean, you know, everything you've done, what factor ranks the highest?
So the leadership, you know, because to finish first you have to finish. So if you want to do the journey of 4 to 16 and in 42 you want to be surviving, you make sure that businesses will be there. But businesses, the last to die, if at all it is failure, will be the leader. And the maximum people make, in fact, what happens is the leader company in this kind of situation, they're always expensive. They will always look expensive. If you think there is going to be boom in cement, don't apply your head. Go and buy Ultratech. You know, because they have multiple ways of making money. Like in banking, particularly lending, it's very risky. Everybody knew that HDFC is a great bank. By 2002-03, it was very clear. But a lot of people, they went to buy the sidees, all sidees. Somebody bought this, somebody bought that. And there is only one compounder out of the entire private sector opportunity, that is HDFC Bank. So you have to buy the leader, and I have seen time again. It is the leaders which make tons of money or maximum money out of that particular tailwind of a sector. So if you have a stock market tailwind like financials, so this time asset managements will boom. Now don't go and buy number 10th or number 12th asset manager. Go and buy the bluest and the biggest and the best managed. Those guys will do, I mean, downside, they may not be the fastest, but they will be there. They will make tons of money.
So out of all the factors, leadership in their respective industries is, you'd rate that the highest.
Yeah, I mean, once you have identified that this business is potential, the business itself has 15, 20%, 25% ROE kind of a potential, and there is a growth potential, then the company to buy or the management to buy is the leadership.
Don't buy the next HDFC Bank, buy HDFC Bank. That was
the next HDFC Bank is HDFC only.
Mr. Damani, how much weight do you put, sir, on sectoral tailwinds, high ROEs, some of the things that Ramdev said, when you are looking at opportunities?
Yeah, Prashant, Ramdev had this formula, QGLP. The one I focus on quite extensively first is P. I'm very concerned the price discounts everything. So more than leadership, more than ROE, more than P, I'm looking at the price I'm paying for it. Sometimes even if I make a mistake, the price is the cigar butt example. You can still make money out of it out there. And generally I find that if you buy when a bull market is starting, an extremely underloved sector, which means the price is very, very cheap, you'll end up making a lot of money at the end of the bull market out there. So almost obsessed. If you ask me about a company or pitch a company to me, almost my first few questions will be what is the market cap of the company? Because that gives me a good starting point. Is it 500 crores, is it 5,000 crores, 50,000 crores, you know? And can I value or see the business at that market cap? So for me, it's P.
And P and of course the market cap relative to the size of the opportunity. I mean, how much?
As I see it, as I see it. You know, if they're in a commodity business, I know the market cap should be this, consumer business should be this. But the market cap is an amazing filtering exercise, you know. Some business I would not look at no matter what, because the market cap is too big for me at this point, for me to understand.
All right, we have to take a short break, but as we do that, the markets are seeing a bit of a recovery from the day's low. We'll get you more on the market action when we return in just a bit.
Welcome back. You're watching us here on Trading Hour, and as we speak, we managed to somehow take the Nifty bank back into the green, led by SBI and a couple of these other private sector banks as well. And there's been a good recovery for the Nifty, which has conquered that 26,000 mark as well. So both on my head as well as Horma's head, we have the markets which are recovering. Wonder whether that's on Ritu's head as well or not. But from what Horma's, me and Ritu, what we'll do is we'll wrap up on this edition of Trading Hour. Thank you so much. We raise our hands and hope that the market continues to stay afloat from the lows that we've seen from today's morning. Ritu, we're waiting for you to raise your hand. There you have it. All right. Thank you so much for watching. Take a short break. Come back. On the other side is Halftime Report.